Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
All right, let's get into it. In the world of corporate tax, what looks like a simple investment can have some really complex consequences. Today, we're going to tackle one of the big ones, the corporate stop-loss rules. We're going to break down what they are, why they even exist, and then walk through a practical example so you can see exactly how they work.
So, to really get why these rules are even necessary, let's first paint a picture of a very, very common scenario. Just imagine a corporation that's doing well, and it has some extra cash sitting around. What's the logical thing to do? Invest it, of course, and try to generate a return. So you've got this simple three-step dance, right? The corporation buys some shares, it holds on to them and gets a dividend payment, and then, down the road, it sells those shares. On the face of it, this looks totally straightforward. It's a routine transaction that happens thousands of times a day. But what if things don't go exactly as planned? What happens if that final sale doesn't end in a profit? What if you actually sell the shares for less than you paid for them and you're left with a capital loss? Well, that's where the tax side of things starts to get really interesting. And this exact situation is what brings a special set of tax provisions onto the stage, what we call the stop-loss rules. Their entire purpose, their whole reason for being, is to prevent corporations from getting an unfair tax advantage out of this kind of transaction. So what is this rule, really? At its heart, it's actually pretty direct. It basically says that the capital loss a corporation can claim from selling shares has to be reduced. And what's it reduced by? It's reduced by the amount of the tax-deductible dividends it received on those exact same shares. But, and this is key, only if certain conditions are met. So what are these certain conditions? Well, think of them as two tripwires, and you only need to hit one of them for the rule to kick in. The first one is all about time. Did the corporation hold the shares for less than a year? The second is about control. Did the corporation own a significant chunk, specifically more than 5% of that class of shares? Okay, that's the theory. But, theory only gets you so far. To really see how this plays out in the real world, we've got to look at some actual numbers. So let's bring in our case study for today, a company we'll call Novascope Corp. All right, so here are the facts of the case. On May 15th, Novascope buys 800 shares of another company, Prism Corp. A little later, on June 10th, it receives a nice dividend. But then, just 10 days after that, it sells the shares for a lower price. And here's a key detail to remember. Novascope has $45,000 in other capital gains from a totally separate transaction that it would love to reduce. Okay, we've got all our facts lined up. Now let's play detective and test those two conditions we talked about to see if the stop-loss rules are going to apply to Novascope. First up, the holding period. Let's see, bought on May 15th, sold on June 20th. A quick look at the calendar tells us that's just 36 days. Well, that's way, way less than 1 year, so boom, condition 1 is met. The rule definitely applies. We could technically stop right here, but just for the sake of being thorough, let's check the other one too. All right, on to condition number 2, the ownership stake. How much of the company did Novascope actually own? Well, the numbers tell us they had 800 shares out of a total of 9,000 that were available. So we just do a quick bit of math here. 800 shares divided by the total 9,000 shares, and that gives us an ownership stake of 8.9%. So let's put it all together. We have a super short holding period of only 36 days and an ownership stake of almost 9%. The big question is, do the stop-loss rules get triggered here? And the answer is a big, resounding yes. I mean, they didn't just meet one condition, they blew past both of them. The holding period was obviously less than a year, and that 8.9% stake is clearly more than the 5% threshold, so there's absolutely no doubt about it, the stop-loss rules are in full effect. Okay, so the rules apply. Now for the really important part. What does this actually do to the company's bottom line? Let's walk through the math, step by step, and see the financial consequences. First things first, let's figure out the capital loss as if these special rules didn't exist. It's pretty straightforward. You take what you sold it for and subtract what you paid for it. This gives us what we'll call the initial capital loss of $2,520. Okay, but now the stop-loss rule kicks in. This is the key moment. We have to take that initial loss we just calculated and subtract the total dividend they received. And look at that. The rule shrinks the loss way, way down, leaving a much smaller permitted capital loss of just $600.
Hold on, we're not done yet. You don't get to deduct that full $600 against your other income. We still have to apply the capital loss inclusion rate, which is 50%. So we take half of that permitted loss, which leaves us with a final allowable capital loss of just $300. That's all they can actually use.
So now let's see how this all fits into the bigger picture of the company's income for the year. First, you have to add in that dividend income. Then you take those other capital gains they had, that $45,000, and now you can finally use that little $300 loss to offset them. Add it all up and you get your net income for tax purposes. Okay, last step. To get to the final taxable income, there's one more crucial adjustment. To avoid taxing the same money twice as it moves between companies, corporations can usually deduct dividends they receive from other corporations. So we subtract that dividend right back out, and that gives us our final taxable income number for the year.
Whew, okay, we just went through a lot of numbers there. So let's step back for a second. What's the big idea here? What is the whole point of this complicated rule?
Well, this entire mechanism is designed to stop a tax strategy known as dividend stripping. It's a clever trick where a company buys shares right before a dividend is paid, collects that nearly tax-free dividend, and then immediately sells the shares for a loss. It's an almost guaranteed loss because the stock's price naturally drops after a dividend is paid out. This creates a convenient artificial capital loss to shelter other income. The stop-loss rule is basically there to close that loophole. It ensures that any loss you claim is a real, genuine economic loss, not just one you manufactured for a tax benefit. You know, this whole case really gets at a fundamental challenge in all of tax law, making sure the numbers on paper actually reflect what's happening in the real world. So it leaves us with a bigger question to think about. Beyond this one specific rule, what other tools and principles does the tax system use to try and separate genuine economic losses from losses that are, well, just creative tax planning?